So I put it here. Monetary asset. So example of monetary asset, of course, will be something like your cash, then maybe your AR. All these are monetary asset. Okay, so what is the implication of monetary asset? Monetary asset, right, actually means eventually you will settle in cash. Okay, eventually you will settle in cash. Okay, so that's the meaning of monetary asset. Eventually you will settle in cash. So example, cash and AR are example of monetary asset. Okay, so for IA, it must be a non-monetary asset. Okay, so non-monetary asset means to say eventually you are not going to settle in cash. Okay, so I think it's quite true lah, because for IA context, our purpose is not to sell it. Our purpose of IA is to use it. So therefore, IA is a non-monetary asset. Eventually, we will not settle in cash. Eventually, we want to use it, right? Okay, so I put here for you. Non-monetary asset means to say your intention is not to sell, okay, but to use it. Okay, so that's the intention of an IA. The purpose of buying this IA is not to sell it. The purpose is to use it. Right. Okay, then of course the last one is without physical substance. So without physical substance, of course, I think you can guess it means you cannot see, you cannot touch. So it's the opposite of our PPE just now. Just now PPE is can see, can touch, right? So now without physical substance means you cannot see, cannot touch. Okay, so now having said all this, right, what is the meaning? Okay, so remember I told you if you want to use IAS 38, right, firstly you need to pass the definition test first. So the criteria of definition is it must be separable. Okay, so in other words, mean to say if you want to apply IAS 38, it must be separable. Okay, if you want to apply IAS 38, it must be separable. If your IA is not separable, then you cannot use IAS 38. Okay, so if your IA, for example, is not separable, you cannot use IAS 38. So of course, here I'm going to ask you, can you think of one IA, right, which is not separable? It's an IA and it is not separable. Any suggestion? There's one IA that you know, I'm very sure you know, it's an IA, but this IA is not separable. Can guess? There's one IA that you are aware of. I'm very sure you will know this IA. And this IA is not separable. So remember, separable means to say you can sell separately, you can rent separately, you can transfer separately, or you can license separately. Correct. Okay, goodwill is the answer. Okay, so goodwill is one example of IA which is not separable. Goodwill. So therefore, right, if you want to know in details, goodwill is not governed by IAS 38. Okay, the IAS that is governing goodwill is actually IFRS 3 and not IAS 38. Okay, hopefully you know why. You can't use 38 because goodwill is not separable, right? Goodwill is not separable. So therefore, you can't apply 38. Okay, so I put here IA not separable example is goodwill. So therefore, you apply IFRS 3. Reason is because fail IAS 38 definition test. Okay, then of course, to be more precise, is this separable? Okay, so understand. So that's the first thing I want to tell you. So remember, goodwill, if you really want to be precise, right, it's not governed by IAS 38. Goodwill is governed by IFRS 3. Reason is because goodwill failed the IAS 38 definition test separable. Okay, goodwill cannot be sold separately, right? Do you think you can tell that further, I sell you my goodwill, the rest of the asset I all keep? No, right? Do you notice goodwill is not separable? You can't sell goodwill separately. You can't rent goodwill, right? You can't transfer goodwill or you can't license goodwill separately. Okay, so understand, huh? So that's this point here. Okay, so that's this definition part. Then second part, we have this recognition. So recognition is the same criteria. You see the rules are the same. Probable means to say very high chance of using or sell the asset. Then future economic benefit is all the same. Probable, right? Okay, just circle this word, probable future economic benefit. Okay, right. So recognition. So let's say, for example, if you fail any of the above, right? If you fail any of the above, what do you think will happen? If you fail any of the above, then of course I can't apply IAS 38. Okay, in other words, means to say I cannot debit IA. So if I fail, right, then obviously what can happen is you can't debit your IA, then you need to debit expense. Okay, right. Okay, so now we have something called initial measurement. Okay, so initial measurement, we have a separate acquisition and a business combination. So separate acquisition means to say I only buy the goodwill, right? Separate acquisition means to say I only buy the goodwill. Oh, sorry, only buy the IA, apology. Only buy the IA. That's the meaning of separate acquisition. Okay, I only buy the IA. Then for business combination, I think you can guess also, means to say you buy the whole business and the business contain IA, right? You buy the whole business and the business contain IA. So that's the meaning of business combination, right? Buy the whole business and it contain IA, right? Okay, I buy the whole business and it contains IA. So that's the meaning of business combination, right? So for initial measurement, the first thing is you need to determine whether you just buy the IA only or you buy the whole business and the business contain IA. Okay, because the measurement is different. Okay, if you just buy the IA, it will be reported at cost price, in other words. Okay, if you just buy the IA, it will be reported at cost price. Okay, then if you buy the whole business and the business contain IA, it will be reported at fair value. Right? Okay, so that's the difference. So you need to decide whether how you obtain this IA. Is it you buy separately or you buy as a business combination, right? So at cost means to say it's the same as our IAS 16. So IAS 16 means to say our ABC, initial cost at point of purchase, and B, cost incurred before first use of the asset, and C, future dismantle cost. Okay, but I think you will not have future dismantle cost here. Okay, then next we have subsequent measurement, right? So subsequent measurement, same thing, you will have two models, right? You have two models. One is cost model. Okay, and the other one, of course, you can guess is revaluation model. Okay, right. So subsequent measurement, there are two models. One is cost model and one is revaluation model. Okay, so of course, most of you are familiar with cost model. Then revaluation model, maybe you're not so aware, right? So remember, we are talking about IA, intangible asset. Okay, so what kind of IA you will use revaluation model? What is the guideline? What do you think? Have you think about it? IA, we also have revaluation model, right? Okay, so for PPE, very simple. For property, plant, equipment, which kind of asset you will use revaluation model? Building, correct? Because building fair value always change. Then how about IA? What kind of IA you will use revaluation model? Any suggestion? You can think of anything? What IA you will use revaluation model? Goodwill is goodwill is not answer. Okay, anyway, apology. Can you think of any? Okay, I tell you, the answer is no answer. Okay, if you didn't type anything, means to say you are right. Okay, so actually the rule for this IA, right? If you want to use revaluation model for IA, of course, the criteria is you need to have an active market to sell. Okay, you must have an active market to sell in order to use revaluation model for IA. Okay, but this is very rare. That's why I say if you do not have the answer, means to say it's the correct answer. Okay, if you want to use revaluation model for IA, yes, you can, but make sure you have an active market to sell. But as I say, this is very rare. Okay, most of the asset do not have an active market to sell. Okay, so maybe some of you are thinking about your Microsoft Office, your software, right? Okay, the one I can think of, maybe you say you're thinking about your Microsoft Office, Microsoft Windows, all these are software, right? So software technically should be under IA, but this type of software, right, you can't use revaluation model. Why? Because you do not have active market to sell. Then of course, I will know some of you will disagree. You say, hey, no, Microsoft Office, I can buy it anywhere at departmental store. There's an active market to sell. Okay, how come you say there's no active market to sell? Okay, then I tell you my answer, very simple. Now, when you buy your Microsoft Office, Microsoft Windows, right, there's always a year. Correct? For example, Microsoft Office year 2022. Yes, no doubt, you have market value. You have this active market to sell. You have the market value, but it's only for year 2022. Correct? If I talk about 2 years later, 2024, in the market, can you still buy 2022 Microsoft Office? No more, right? So can see, so that's the reason why Microsoft Office, Microsoft Windows, right? You can't use revaluation model as well because you do not have the market price. Your market price is only available in 1 year. All right. Okay. So remember, 3 years later, I'm supposed to do revaluation, right? But 3 years later, I do not have the market price anymore. Can see? All right. Okay. So that will explain to you how come Microsoft Office, Microsoft Windows, you can't use revaluation model as well. Okay. So bear in mind, because I only have market value for 1 year. I do not have market value for the subsequent years. Okay. So therefore, revaluation model, if you ask me to quote any example, I would say 0 because it's really rare. In Vietnam, I don't think so also. Right. Okay. The standard, they only have given one example. Okay, I just share with you, but I think the example is not valid. Okay, it's not valid. In some country, right, they have something called taxi license. Taxi license, they say is IA that has market value, right? Taxi license, they say there's an active market to sell. Okay, but in Vietnam, I don't think you can sell away your taxi license, right? In Singapore, same thing. We also can't sell away our taxi license, right? So therefore, I say it's very rare. This is the only example given by the standard taxi license in certain country. Okay, definitely not in Singapore and not in Vietnam, right? Okay, so this whole page here, 13, is talking about the general principle of 38. Right, okay, then now we talk about here, a blank page. Okay, so now just want to give you a summary of intangible asset. Okay, so our focus is on intangible asset. Okay, so strictly speaking, intangible asset, there are 4 categories. Okay, 4 categories of intangible asset. 4 categories. Okay, so I draw for you here. 1, 2, 3, 4. 4 category of intangible asset. Okay, the first one is what I call the normal IA, the normal kind of intangible asset. Okay, normal IA. The second one is what I call the research and development. Okay, and the third one is called goodwill. Okay, and the last one is other internally generated IA. IA, of course, stands for intangible asset. Okay, so broadly speaking, IA, there are 4 categories: normal IA, R&D, goodwill, and other internally generated goodwill. Okay, so let's talk about this one first. Normal IA. Normal IA. Okay, so the full points are on the next page. Normal IA. Okay, now, of course, in your exam context, right, if you talk about normal IA, there are 2 categories. One is finite life. One is infinite life. Okay, so I think you can guess the meaning of finite life. Finite life means to say you are able to determine the number of useful life. That's finite life, right? Then, of course, infinite life must be the opposite. Opposite means to say you are unable to determine the number of useful life. Okay, so finite life, there are 2. One is able. Okay, one is able and one is unable. Right, okay, just give me a second. Becoming worse. Okay, so anyway, this one is unable, right? Don't want to waste time on here. Okay, this word is unable. Okay, now, okay, now, in your exam context, right, they will not be so nice to you, right? Okay, they want to be so nice to you. What they will do is they will give you very weird IA, right? They will give you the name IA. For example, permission to emit CO2. This is a IA, right? Intangible asset. Means to say you have the permission to emit CO2. So you see the name very, very funny, right? Okay. So in exam, if you see all these very funny name, don't be scared. Okay, don't be scared. It can be permission to emit CO2 or maybe permission to emit HO2, whatever. All right, okay. Don't worry. The name is not important. In your exam context, right, the first thing you must look out for is whether there is useful life or no useful life. That's most important. A lot of people thought accountants are so-called superhuman. They know everything. No, remember, accountants are not scientists. You do not know this about CO2. You don't need to know. Accountant only need to know whether this IA have finite life or no finite life. That's all. This is what you need to know. Okay, so in exam, if you see very funny name of the IA, not important. Most important is see whether useful life is given to you or not. Right? If useful life is given to you, then it will fall under this category, finite life. If useful life is not given to you, then it will fall under infinite life. Okay? So name of the asset is not important. So you can see, I can give you one example. Right to use a customer list. If I say I have the right to use a customer list for 10 years, then it will be finite life. Okay? So if I just change the question a little bit, right to use a customer list forever, it will be infinite. So can see the name of the IA is not important, right? Same name, may have different treatment. Okay, so most importantly is look out in the question to determine whether any useful life is given. Okay, right. So IA with finite life, very simple. You have useful life, then it's the same as what we normally do. You will amortize over life. Amortization, I think everybody know. Another word for depreciation, but used for IA. Okay, so when you buy, maybe buy IA, you will debit the IA and credit bank. Okay, the accounting is the same. So I think this one I have nothing to mention. Only this 2007, this 2007 is just the cost. Okay, just the cost 3,000 minus 300. Okay, so it's exactly the same. Right, 3,000 minus 300. 300 is the amortization. Okay, so that's IA with finite life. Okay, then now we talk about IA with infinite life. Okay, so it's also very clear cut. If you remember, infinite life means what? Infinite life means no useful life. Correct? No useful life. That's the meaning of infinite life. So accounting treatment will be very natural as well. Okay, so if you do not have useful life, right, then obviously there's no way you can calculate amortization. Do you see it gel out very nicely? If I do not have useful life, then no way I can calculate amortization. So therefore, for IA with indefinite life, right, no amortization. Okay, but subject to impairment test every year, right? Subject to impairment test every year. So of course, this word might be new to you, impairment test every year. Okay, so impairment is actually inside our syllabus. Maybe today or maybe tomorrow, we will talk about impairment. So let me just share a little bit here. Impairment is IAS 36. Okay, so impairment definitely is a bad thing. All right, it's a bad thing. So usually what people define impairment is what? Put here. Impairment, usually people will say it's a bad thing. So actually impairment is a fall in value of asset. Okay, so that's the definition of impairment. Most people will say impairment is a fall in value of asset. Okay, then of course the question is, then what's the difference between depreciation and impairment? Depreciation is also fall in value of asset, right? Amortization is also fall in value of asset. Then how do you differentiate between impairment and depreciation? Okay, so for impairment, you need to add 3 more words. Impairment is fall in value of asset below carrying value. That's impairment. Okay, so if your asset fall below carrying value, then impairment has taken place. Okay, so that's impairment. Then some will say, how come asset will fall below carrying value? Is that possible? Definitely yes. Okay, I just give you one example. So you just imagine we are having a physical class in November. Let's say for example, I'm inside FTMS room, then you are sitting there. So of course I'll be using the projector to write all this, right? Okay, so projector inside FTMS books is a PPE because they use it to provide services, right? Okay, so maybe at that point of time, the projector is worth $300 USD, the visualizer, right? Okay, what happens if I break the visualizer into 2? Right? So if I break the visualizer into 2, right, definitely the value will not be 300 anymore. Can see the value maybe become $10. So do you see impairment has taken place? Fall in value of asset below carrying value. Okay, right. Okay, so impairment we have a separate chapter coming soon. So let's say for example, you calculated the impairment is a 1,000. Okay, impairment definitely is an expense, a bad thing. So it will appear in your P&L as an expense, 1,000. Then of course, it will also reduce your asset, right? So means to say it's 3,000, then minus the impairment 1,000. So therefore, I will report at 2,000. Okay, right. So that's the accounting treatment for normal IA, right? So normal IA can be, the name of the IA not important, as I say. It can be what, patent, it can be copyright, it can be logo, it can be trademark, etc. The name of the asset is not important. Most important in your exam, see whether useful life is given to you or not. Okay, so in your context, it's only two categories, whether there's useful life or there's no useful life. Okay, then you can do accordingly. So let me give you a summary here. Okay, so the first one, we talk about normal IA. Okay, so don't care about the name of the IA, not important. Okay, most important thing is you need to decide whether there is useful life or no useful life. That's all. Okay, so as far as you are concerned, if there's useful life, then this will be called finite life IA. Okay, so first step, finite life or infinite life. Okay, so if it's finite life, then nothing special. Just remember to do amortization. Okay, so if it's infinite life, then obviously no amortization. Because you do not have useful life. Okay, so no need to do amortization, but bear in mind, you need to do impairment test every year. But subject to impairment test every year. Okay, right. So that's the accounting treatment for normal IA. I think quite easy lah, this one. Okay, so I repeat one more time. Normal IA, remember, don't care about the name of the IA. In your exam, the name will be very weird. Like what you see just now. Permission to emit CO2. Right? Some funny wordings which you never see before. Okay, name of the IA, not important. Most important, read the question to see whether any useful life is given. If useful life is given, then you will need to do amortization. If useful life not given, then no amortization, but subject to impairment test every year. Okay, right. Then now, next we talk about R&D. So again, R&D, of course, sounds very complicated. Okay, it sounds very complicated. Now, so you must always remember what is your role. Your role is not the scientist. If I talk about R&D, people will talk about inventing things, right? Invention, that kind of thing. Okay, so I emphasize you are accountant. You are not the scientist, right? So a lot of people thought R&D very hard because they thought they are scientists. Okay, remember, you are accountant. Okay, so R&D. So example I can think of now, of course, now we have some example which I can show you apart from here. Example of R&D. All the way from research to development. What I can think of, the recent one, correct? Very relevant to us is the COVID-19 vaccine. Right? COVID-19 vaccine. This is one example of R&D. Do you see COVID-19 vaccine all the way from nothing, right? No technology until production. That's example of R&D. Understand? From zero knowledge until production. Okay, so this one I think it happens in our lifetime. Okay, then the other one I can think of, which you are aware of, is the electric car. Okay, so I think when you are young, when you're a baby, there's no electric car, right? Electric car only appear quite recently. Okay, so same thing from zero technology all the way until production. So do you understand what's R&D now? R&D simply means here from research, okay, then become development, then become launch. Launch means production start. Something like that. That's R&D. Okay, research, then you develop, then you launch the product. Okay, so as I say just now, remember, you are not the scientist. You are the accountant. Accountant no need to know how to invent COVID-19 vaccine. Accountant no need to know how to invent electric car. Accountant only need to know debit what, credit what. Okay, so make this clear. We are accountant, not scientists. So to give you one example, of course, if you look at this picture here, I think maybe some of you know, this is actually a time machine. All right. So let's say, for example, we are trying to R&D a time machine. Okay, right. So when you are trying to R&D a time machine, right, nothing special. Your company will spend money, right? Maybe, for example, spend money on this, what, chlorine, azine. Okay, so do you think as an accountant, you need to know what is this for? Chlorine, azine, what is it for? Do you think you need to know? In my context, as an accountant, I don't care. I just want to know this is what. To me, it's just material. I will not need to know what is it for. Okay, so when trying to research this time machine, I will incur expenditure. For example, chlorine. Then, for example, I need to pay the salary of scientists on 31st January. Then 31st January, I need to pay rental. Okay, so say, for example, a happening date, 1st February. Okay, 1st February, I discover the knowledge. Okay, on 1st of February, I discover the knowledge. A very happening day. Okay, so after I discover the knowledge, of course, life still go on. Then 20th of February, I pay the salary. Then 20th of February, I pay the rental. Okay, so as I say just now, accountant context, the most important thing is you must know how to record this transaction. Okay, so all this, right? Where will you debit? That's what you are interested. The credit, of course, must be bank. This one, without doubt, everybody will know. Okay, the thing is where to debit. Will go where. Okay, so very simple. I give you a summary of R&D. Very simple. The most important thing is you need to know when you discover the knowledge. For R&D accounting, right? R&D accounting, the most important is you need to know when you discover the knowledge. This day is very important. Okay, this day is very important when you are recording R&D. The day you discover the knowledge, you need to know this day. Okay, why is it so important? Very simple. Expenditure that is incurred before the knowledge is discovered, right? All these are called research. Okay, so expenditure that you incur before the knowledge is discovered, all these are called research. Okay, then of course, I think you can guess expenditure that you incur after the knowledge is discovered, then all these are called development. Okay, right. So that's my fastest example to you to demonstrate to you what is research and development. Okay, this is the super shortcut lah, super shortcut. Okay, so remember the most important thing is you need to know when you discover the knowledge. Right, so expenditure incurred before the knowledge is discovered, called research. Then expenditure incurred after the knowledge is discovered, then called development. Okay, then of course these two, the accounting treatment is different. For research, right, they will ask you to debit expense. Okay, then for development, they will call you to debit development, which is asset. Okay, I put asset, just asset. IA. Okay, so understand? So roughly like that. So important thing is determine when you discover the knowledge. Okay, so this is the super shortcut. Then now back to the full details now. So the issue is this, like what I say just now, the issue is the company incur expenditure. Okay, company incur expenditure means spend money, but do not know whether it should be classified as research or development. This is the issue, right? You spend money, but you do not know whether you should classify as research or development. Okay, that's the situation. Incur expenditure, but do not know whether it should be classified as research or development. Now, why is it important to know? Because research and development, they have different accounting treatment. That's why you must know. Okay, I think you already know. Research, you expense off, right? Research, you expense off, then development, you will capitalize as asset. Okay, so that's what they're trying to say. Research and development, they have different accounting treatment. So therefore, you need to make sure you know. Okay, so research, what they say is this activity or original and planned investigation undertaken with the prospect of gaining new knowledge. Okay, so this is your English. So to me, research means activities aimed at obtaining a new knowledge. Okay, so new knowledge also means to say the knowledge not invented yet. Okay, so research means what? Whatever you do to obtain a new knowledge. So new knowledge means the knowledge has not been invented yet. Okay, you have not invented the knowledge yet. So example must be what? There are so many examples, right? So example can be a salary of a scientist. Salary of a scientist example. Okay, so that's research. So now we look at the accounting treatment to research expenditure, the accounting treatment. So that's what they say. All expenditure on research other than PPE should be written off through income statement. Okay, so other than means what? Other than means except PPE, right? Okay, except PPE. Put it here. Other than means except PPE. So it's very clear now. All expenditure except PPE should be expense off. Okay, so all expenditure except PPE, what you should do is to expense off. Expense to P&L. Okay, then of course the next question is, then what happened to my PPE? Right, so do you see computer? Computer is actually a PPE. Computer is actually a PPE. So PPE, what do you do? PPE, of course, you follow IAS 16. Capitalize as per IAS 16. Right, PPE. So what you need to do for PPE, you need to capitalize as per IAS 16. Okay, so this is the accounting treatment for research. Expense of except PPE. So PPE, you will need to capitalize as per IAS 16. Right? Okay. So next question is, how come research should be expense of and not capitalized? Okay. I put here for you why research should be expense of. Any suggestion? How come research you will expense of? How come cannot capitalize? Why research should be expense of? Why cannot capitalize? Any suggestion? How come research cannot capitalize? How come I need to expense of? So remember, it's the same old thing. If you cannot capitalize, means to say you cannot debit asset. If you cannot debit asset, must be you fail some criteria. So which criteria do you think they fail? So asset must be what? Must be probable, correct? So in this case, research, do you think is probable? Is it very high chance? So let's say, for example, I'm trying to invent a time machine. At the time of invention, do you think I have a very high chance of success? No, right? Okay, so therefore, that's the implication. Why research should be expense of? Okay, answer is because fail recognition probable. Remember, if you want to recognize as an asset, it must be probable. So probable means very high chance, correct? So in this case, is not probable. Okay? That's why we can't debit IA with research because they failed the recognition test. Which recognition test? Probable. Okay, at this point of time, it's not probable yet. Okay, I put one more yet, then it sounds better. Okay, fail recognition test, probable. Now, at this point of time, it's not probable yet. Okay, right. Then next is, what is this development? Development means application of a research knowledge. Okay, so the keyword, of course, is application. Apply already. So by now, at development, right, your knowledge has already been invented. Okay, so if you are at this development stage, right, knowledge has already been invented. Okay, knowledge has already been invented. Okay, so at this point of time, if you are at this development stage, you have already invented your knowledge. Right? Okay, knowledge has already been invented. So one example of development expenditure is a prototype. Right? So a lot of people, I think they will see before this word prototype. But what is this prototype? Okay, prototype is actually the first output to test a research knowledge. That's a prototype. Okay, the keyword is the first output, the first one, the first output to test a research knowledge. Okay, that is prototype, the first output to test a research knowledge. Okay, right, so you know what's development now. So what's the accounting treatment for development? The answer is capitalize, means debit asset. Capitalize development expenditure as IA when all the following 6 criteria are satisfied. Right? Okay. So you should capitalize, means debit IA. Put here for you. IE debit asset, intangible asset. Okay. You should capitalize as IA when you satisfy all the 6 criteria. Okay, so if you satisfy all the 6 criteria, then you can capitalize your IA. Right. Okay, so what are the 6 criteria? The first one is technical feasibility. Right. So what is the meaning of technical feasibility? Right. It means, do you have the knowledge to complete? Okay, the keyword is knowledge. Do you have the knowledge to complete? Okay, right. So do you have the knowledge to complete? So if you ask me for industry application, right? So if let's say my company is doing R&D, right? How do I prove that I have the knowledge to complete? Usually for me, I will look at my staff. Okay, I will look at my staff. So what do I mean when I look at my staff? STAFF. Okay, so say for example, if I'm trying to invent a time machine, then I tell you all my staff are accountant. Do you think I will have the technical feasibility to complete? Definitely no, right? Okay, so if you want to prove that you have the technical feasibility to complete, at least you must prove that your staff, there are some scientists around. Okay, there are some scientists around, some engineer around. Then you'll be able to prove that you have the technical feasibility to complete. Okay, so critical part will be staff. Then second one is you must have the intention to complete. So intention to complete means to say, do you want to complete? Do you want to complete? It's just like you can apply to yourself, correct? Your intention is, I want to pass ACCA, correct? I want to pass ACCA. But the thing is, do you want to complete? So if you want to complete, right, then of course you need to study. That's for sure. All right. Okay. So industry evidence, right, for this, do you want to complete, is you need to have a plan, right? You need to have a plan, or some people say a timeline. Okay. You need to have a plan or a timeline. Okay. You know what's a timeline? They say, or by first week, I must complete which stage. By second week, I need to complete which stage. That is called intention to complete. I need to have a plan. Just like if you want to pass ACCA, you cannot just repeat to yourself, I want to pass ACCA. I want to pass ACCA, but no action done. Just sit down there and say, I want to pass ACCA will not help you. You need to have a timeline. First week, complete IAS 16. Second, or no, first 1 week, too long. 2 days, complete IAS 16. 1 day, complete IAS 38. Something like that. Okay, so that's called a timeline. All right. Okay, then the next one, ability to use or sell. So ability to use or sell is, you need to ask yourself this question. Ability to use, of course, is, are you the owner? Okay, so if you are the owner, of course, this will demonstrate you have the ability to use. All right. Then how to prove the ability to sell? How to prove you have the ability to sell? Okay, to prove you have the ability to sell is you just need to have some potential customer. Okay, no need to be confirmed customer. At least you can prove you have some potential customer. Right? So if you have potential customer, I think that will be the evidence to sell. Ability to sell. Right? Okay, ability to use means to say the asset must belong to you. Right? Okay, so that's ability to use or sell. Then number 4, generate probable economic benefit. Right? So this one I think everybody know. Generate future economic benefit means to say can use or sell in the future. Okay, then of course in industry, how do you prove it? How do you prove that you can use or sell in the future? How do you prove future economic benefit. Okay, so if you ask me on my day-to-day work, if I want to prove this, right, I will prove it if I have a positive NPV. You know what's NPV, right? Net present value. So it's a project, then of course you need to do cash flow, inflow minus outflow. Then your net present value must be a positive one, right? So if your net present value is positive, then I think you satisfy this criteria. Generate probable future economic benefit. Okay, right. The next one is availability of adequate resources. Okay, so this one, nothing special. This one simply means to say, do you have enough money or manpower? Okay, do you have enough money or manpower? So you cannot say, oh, I have money, a lot of money, but no staff. So can't, right? You can also cannot say, I have a lot of staff, but no money, right? So you need to have enough resources. Okay, and the last one is ability to measure the cost, right? Ability to measure the cost means to say the cost that you debit, right, must be reliable. Do you have the ability to measure the cost reliably? Okay, then of course, you want to debit asset, right? So if you want to debit asset, cost, how to prove it? You need to have documents to prove the expenditure. Okay, so example, of course, will be your supplier invoice. Supplier invoice is an external document. So therefore, if you have a supplier document, I think the amount you put is reliable. Okay? Able to measure the cost reliably. To prove it's reliable, you need to have supplier invoice. Okay, you cannot say, oh, I think this costs 10,000, so I just put 10,000. People ask you for supporting document, you say, I don't have. I feel it's worth 10,000, so I put here 10,000 based on my feeling. I feel it's 10,000. Okay, so obviously can't work, right? So you fail this criteria. So to pass this criteria, you need to have supporting document. For example, supplier invoice. Okay, right. Then the last point is, when do you start amortization? You start amortization when production starts. Start amortization when commercial production starts. Okay, right. Then how come choose this date? How come must start when commercial production start? Okay, if you want to know why, then I tell you, this one is actually because of your matching principle. Okay, matching principle. Okay, now how to match to your matching principle? Very simple. Matching principle means income match with expense, right? So production starts, right? When production starts, it means what? And production starts, it means money starts to come in, right? Production start means money coming. Okay, then I think you can see the relationship to your matching principle now. Okay, production start means money start to come in. Then of course you can match with your expense, which is amortization. Okay, right. So this is the accounting treatment for research and development. This is the accounting treatment for research and development, right? So you can put it here to show you. Just now we have a summary page, right? Okay. R and D. Okay, so R and D, there are two categories. One is research and one is development. Okay. One is research. Okay, so if you remember research, what do you do? Research, you will expense off asset PPE. Okay, expense off asset PPE. Then for development, what do you do? So for development, you should capitalize as IA. Capitalize as IA when all 6 criteria are satisfied. Okay, you should capitalize as IA when all 6 criteria are satisfied. Okay, then also remember when to start amortization. Okay, remember when to start amortization. The answer is you should start to amortize when commercial production begin. Right? Okay, so amortize when commercial production begins. Okay, so that's the summary for R&D. Okay, so next we have something called goodwill. Right, next we have something called goodwill. Right, so goodwill is here. So goodwill, if you ask me what is goodwill, if I put it into simple English, it means reputation. Correct? Goodwill means reputation. Okay, so there are 2 categories of goodwill. One is called internally generated goodwill. Internally generated goodwill. Okay, and the other one, of course, is the opposite. But opposite is not called externally generated goodwill. The other one is called purchase goodwill. Right? Okay, the other one is called purchase goodwill. So 2 categories of goodwill. One is internally generated goodwill, and the other one is purchase goodwill. Okay, then now we want to talk about the accounting treatment for these 2 categories of goodwill. So for internally generated goodwill, very simple rule, not allowed. Okay, now why not allowed? Basically, it's because of this word called internally. That's why it's not allowed. Okay, so I give you one example. Okay, then probably you will understand better. So let's say, for example, I have one company, right? Okay, I have one company. I call myself Ivan Lim PLC. This is my company, right? Then inside my balance sheet, okay, inside my balance sheet, I'm going to include one asset called goodwill. Okay, so remember, goodwill means reputation. So I include in my own balance sheet. Ivan Lim is me. Then I put my own balance sheet. I tell people my reputation is worth US 10 billion. Okay, then this goodwill is actually Ivan's goodwill, Ivan's reputation. Goodwill, Ivan's reputation. Okay, so of course, you will tell me confirm not a lot, correct? But maybe you can't tell me the reason. Okay, by feeling you feel not right, confirm not a lot. Okay, then I tell you the reason given by IAS. How come they say internally generated goodwill is not allowed? Okay, so bear in mind it's internally generated. They say it's not allowed because this US 10 billion is not reliable. This amount is not reliable. How come this amount is not reliable? Because this amount is internally generated. And if anything is internally generated, you will be biased. Okay, so that's why not allowed. The keyword is internally. Right? Okay, this is the keyword. So remember the story. Internally, they say not allowed because this is not reliable. How come not reliable? Because you'll be biased. Okay, you generate yourself. That's why not allowed. Not reliable, you'll be biased. Okay, so this is the direction. Okay, then for purchase goodwill, of course, this is allowed. Okay, so purchase goodwill, I think nothing special, means to say you take over an existing business, right? So maybe, for example, I have the purchase price. Okay, then maybe I compare with the fair value of net asset of the business, right? Okay, then of course, if any assets I pay, then it will be called a goodwill. Okay, so any assets is called goodwill. So goodwill, how come there's goodwill? How come you're willing to pay a higher price? Goodwill may exist because of what? Many reasons. Maybe you have a good customer list, right? Or maybe you have very good staff. That's why people take over your company and they don't mind paying a higher price. Okay, so for goodwill, of course, there are two categories. For this purchase goodwill, for this purchase goodwill, there are two categories. One is positive goodwill and one is negative goodwill, right? So positive goodwill, something normal, which I think you know. So cost of investment, 800, fair value 200. So the extra that you pay, of course, will be called goodwill, 600. Okay, 600. Then the double entry, also very simple. This goodwill, they allow you to recognize. You will debit goodwill, 600. Okay, then of course, you will debit your investment, 800. Sorry, investment is 200, apology. Okay, and you credit your bank, 800. Okay, so this is positive goodwill. Okay, so ultimately, remember what you have done is you have recognized the goodwill as asset. Okay, what you have done is you have recognized goodwill as IA. Okay, I put here for you. What you have done is you have actually recognized goodwill as IA. So it's recognized as an asset. Okay, so for subsequent measurement, same as IA with no finite life. So if you remember, what is the accounting treatment for IA with no finite life? Okay, the answer is no amortization, but subject to impairment test every year, right? Okay, so I write here for you, no amortization. amortization, but subject to impairment test every year. Okay, so this is the subsequent measurement. No amortization, but subject to impairment test every year. Okay, so that's the accounting treatment for purchase goodwill, positive goodwill. So now we look at another situation, which is negative goodwill, right? So what's negative goodwill? So if you want to understand better, right, I think I need to tell you the other name. The other name for negative goodwill is also known as bargain purchase. Okay, so I think bargain purchase, these two words, right, will explain to you the meaning of negative goodwill. Okay, negative goodwill means bargain purchase. Right, so example is this. You pay 200 cost of investment. Okay, but the value of your investment is 800. Okay, so do you see now what happened? Your goodwill become a negative amount. Negative 600. You can see? Normally it's positive, right? Now it's negative. So do you see? I think it will be better to call a bargain purchase. The investment is worth 800, but you only pay 200. So do you see it's a bargain purchase? Okay, so then some will say, how come this kind of situation will appear? Of course, yes lah. This situation will appear. Why? Especially if you need money. Correct? If you need money, then anything can happen. Okay, so don't be alarmed that this kind of situation might appear. Right? So during recession, a lot of company that is doing well, they also sell off their asset, sell off the business. Why? Because they don't have cash flow to carry on anymore. Even though they have a very solid business plan, they have very good customer list, etc., they still sell it off. Okay, because no more money. What to do? Understand? Okay, right. So accounting treatment for negative goodwill, very simple. So negative goodwill, negative, you will credit goodwill. Credit. So let me emphasize, credit. Normally it's debit, right? This one you credit. Okay, then of course the debit will be the same. Debit will be your investment. Okay, so your investment will be 800. Then of course you will credit your bank. $200. Okay. Subsequent measurement is you need to recognize to your P&L as income immediately. Right? Recognize to P&L as income immediately. You need to release this goodwill to P&L. Right? So I need to remove it by debiting goodwill. Remove it. Debiting goodwill 600 and credit income means P&L 600 immediately. Okay, right. So that's the accounting treatment for negative goodwill. So let me give you a summary here. So now we have goodwill. Okay, so remember goodwill, there are two categories. One is internally generated goodwill. Okay, and the other one is purchase goodwill. Okay, then hopefully you remember the treatment. Internally generated goodwill. Remember what you need to do? Answer is not allowed. Okay, so remember why not allowed? Because the amount is not reliable. Why not reliable? Because you will be biased. Why you be biased? Because it's internally generated. So therefore, you will be biased. Okay, then for purchase goodwill, accounting treatment is you can recognize as asset. Recognize as IA goodwill. Okay, but next is what? No amortization because you do not have useful life, right? Okay, you won't be able to tell how long your reputation can last. So therefore, no amortization. Okay, no amortization because you do not know the useful life, but subject to impairment test every year. Okay, so this is the accounting treatment for goodwill. So firstly, go and decide whether this is internally or purchase goodwill. Right, okay, then the other one is other internally generated IA. So of course, you see I got no more notes, right? Because this one very simple. Other internally generated IA. For example, okay, you generate your own customer list. Okay, put here internally generated customer list. Okay, other internally generated IA, for example, is internally generated customer list. Very simple. Accounting treatment not allowed. Anything that is internally generated, not allowed. Right? So I think you can guess the reason. Not allowed because the amount will not be reliable. Okay, the amount will not be reliable. I think you can guess why not reliable, because it's internally generated. You will be biased. That's why not allowed. Okay, right. So that's the end of this IAS 38. Of course, which one is most important for exam? Definitely is R&D. Okay, so make sure you know how to react for R&D. Put a star for you. R&D is the most important one. Okay, so remember the rule, R&D. Firstly, you need to know when you discover the knowledge, because once you know when you discover the knowledge, then you'll be able to distinguish whether it's research or development. Okay, so remember, research you should expense off. Development capitalize when you satisfy all 6 criteria. You should only start amortization when commercial production begins. Okay, right. So let's look at one question here. IAS 38 question 2. Of course, it's at your workbook, page 304. Okay, right. So for this question two, a company had 20 million of capitalized development expenditure at cost brought forward at 1st October X7. So let me fast forward. You see my financial year end is 30th September, right? So they say 1st October X7, then of course must be the brought forward figure. So this 20 million is a brought forward figure. Okay. In respect of product currently in production. So let me ask you one question. They say in respect of product currently in production. These three words, right? Currently in production is a hint. Hint for you to do what? When I say hint means the H-I-N-T, hint. It's a hint for you to do what? Any suggestion? Currently in production is a hint. Hint for you to do what? Amortization, correct. Okay, so remember amortization should start when production starts. Okay, so it's a hint for you to do amortization. Very good. Okay, and a new project begin on the same day, right? So two category of project. One is the brought forward one, and the other one is the new project. Okay, so actually, if you have read the question, you will notice this whole chunk here are information relating to the new project. Right, this whole chunk here are information relating to the new project. Okay, then continue. The research stage of the new project lasted until 31st December X7. Okay, research lasted until 31st December and incur 1.4 million of cost. Right, so firstly, this 1.4 million must be research expenditure, correct? This is research. That's what they say. This is how much they spend. From that date, okay, so I don't want from that date, so I put a date for you. They say lasted until 31st December X7. So from that date must be 1st January X8. Okay, from that date must be 1st January X8. The project incur development cost of 800,000 per month. Okay, 800,000 per month. Then on 1st April X8, the directors become confident that the project will be successful and yield a profit well in excess of cost. Okay, then of course, this is the significant day. This 1st April X8. The question say directors become confident that project will be successful and yield a profit well in excess of cost. So of course, the question is 1st April X8 is what date? What do you think is this day? Okay, the crew is director become confident that project will be successful and yield a project well in excess of cost. So 1st April X8. What's the date? Don't tell me April Fool. 1st April is not the April Fool. 1st April X8 is what? Crew is director become confident that project will be successful and yield a profit well in excess of cost. So do you notice yield a profit well in excess of cost is one of the criteria, correct? The positive NPV, right? So actually 1st April X8 is the day by which all 6 criteria are met. Okay, 1st April X8 is the day by which all 6 criteria are met. Okay, so I write here for you. This 1st April X8 is the day the so-called all 6 criteria are met. Okay, so it's only after this day, right, you can start to debit your IA. Okay, before all this day, all cannot debit IA, all have to go to expense. After the criteria are met, then you can start to capitalize. Okay, project was still in development. What does that imply? Okay, I think should be able to guess. Still in development means to say you have not start production, right? So production not start means to say you do not amortize. Okay, still in development means production has not start. Okay, production has not start. So also means to say no amortization. Okay, right, then capital expenditure, capital development expenditure is amortized at 20% using straight line method. Okay, so they ask you what amount will be charged to P&L for the year ended 30th of September in respect of the R&D. So let me give you a summary here. This is question 2. IAS 38, question 2. Okay, so here I'm trying to write for you the summary. Okay, the first thing I see is this 1004. Right, so 1004 is a research. Research expenditure, that's what they say. 1004 is a research expenditure, right? Okay, then next, from that date, incur development cost of 800,000 per month. Then on 1st April exit is the day criteria met. So we want to know this period from 1st of January X8 until 31st March X8. During this period, right, criteria is not met. Okay, during this period, criteria not met. All right, so criteria not met, of course, you will need to expense off. Okay, you will need to expense off. Okay, so here is how many months? January to March is 3 months. You need to expense off 800 times 3, right? Expense of 800 times 3, and you will get 2004. So this period I cannot capitalize because I have not met the criteria. So I need to expense off. Okay, then of course, one more sentence. They say starting from 1st April X8 to this financial year end 30th September X8. Okay, so during this period, of course, your criteria are met. Okay, so criteria are met. Of course, the accounting treatment is you can capitalize. Okay, you can capitalize, but do not amortize because they say still in development. Still in development means to say production has not begun. Go capitalize, but do not amortize. Okay, so this is the summary of the question. So if you read the question, they ask you what amount will be charged to P&L, right? So they want SOCI figure. So SOCI. SOCI figure, I think there's only 2 elements. One is research. Okay, and the other one is amortization. Okay, the new project, there's no amortization, but the brought forward project, you will need to do amortization. Okay, then I think after you add these 2, then that's it. You'll be able to find the answer. Okay, so research, what do we have? we have a 1004 and a 2004. These two, right? This is research and this is also research expense of, right? Okay, so here I will have a 1004 plus a 2004. And that will be 3008. Okay, then amortization, I just need to do a calculation. They say it's 20%. So my brought forward figure is 20,000. So I just need to calculate 20% times 20,000. So that will be equal to 4,000. So total is 7,800. Okay, so answer must be C for Charlie. Okay, so that is IAS 38. Okay, then now of course we will move on to the next question. Okay, so I see all is good, so far so good. Okay, next is the next chapter. Just give me a second. Okay, next chapter is investment property. Okay, right. Investment property, firstly, have to tell you, don't be misled by this word property. Now, property include land, right? So it's not just talking about property, include land as well. Okay, so remember, investment property include land, even though it's called investment property. Not just property, also include land. Okay, first thing. Now, investment property, what is the purpose? Why you want to buy investment property? The purpose, right, is to earn rental income or and capital appreciation. Okay, the purpose is to earn rental income or you hold it for capital appreciation. Now, if you notice our PPE, right, we also have a property. The first word of PPE is a property, the first word, the first P. Correct? So this P stands for property. Then what is the difference between IAS 16 property and investment property? Right? So for IAS 16 property, the purpose of buying the property is for own use. So let me come here. Just give me a second. Okay. The purpose for IAS 16 property is for own use. Okay, so that's how you differentiate between IAS 40 property and IAS 16 property. Right, 140 is to earn rental income or capital appreciation. Then 16 property is for own use. Okay, now measurement of investment property. Initial measurement is at cost. At cost, same as IAS 16, means to say your ABC. Subsequent measurement, you have two models. Okay, the first model is cost model. cost model. Okay, the other one, be very careful, is not revaluation model. Okay, the second model is called fair value model. Okay, not revaluation model, it's fair value model. Okay, so same thing, choice of cost or fair value model must be applied consistently to all investment property. So what this means is this: if you have many investment property, you can't say, oh, this property A and B I use cost model, then property C and D I use fair value model. You can't do that. Okay, so have to be applied consistently to all investment property. Okay, that's the first part. Okay, then for cost model, of course, nothing special. Cost minus accumulated depreciation. Okay, one extra thing is you need to disclose your fair value, right? Okay, for investment property, even though you are using your cost model, you still need to disclose your fair value. Fair value must be disclosed. Okay, then now let's talk about fair value model now. Okay, so I put here first sentence, please note that IAS 16 is called revaluation model. Okay, IAS 16 is called revaluation model. Then now it's called fair value model. What's the difference between fair value model and revaluation model? Okay, the difference is the changes in fair value, right? Where it will go to. So for fair value model, changes in fair value, of course, will go to your P&L. Okay, then for revaluation model, the changes in fair value will go to OCI, other comprehensive income. Okay, so that's the difference. Fair value model and revaluation model. I highlight for you, fair value model and revaluation model. One go to P&L and one go to OCI. Okay, so for example, 2019, 3 million, 2020, 4 million. So if there's an increase in the fair value, what I will do is this: I will debit my investment property by 1 million. Okay, then of course, fair value model, right? So it will go to P&L. 1 million. Okay, so bear in mind, if you are using this fair value model, no depreciation. Okay, no need to calculate depreciation anymore. Okay, fair value is measured every year. Okay, so fair value is determined by the following order. Okay, the best is you have the market price. This is the best choice. If you do not have a market price, then no choice, use a recent price of a similar property, right? So similar property means what? If you are selling level 2, then maybe you can look at level 3, right? If let's say recently they sold off level 3, you can use that as a basis for you to calculate your fair value. Okay. And number 3, if you still do not have it, then you need to calculate a discounted cash flow. Right? Okay. Discounted cash flow. Okay, so discounted cash flow based on the reliable estimate of future cash flow. So this one means you need to calculate a DCF for entire useful life. All right, then of course, DCF means to say your inflow minus outflow, right? Inflow minus outflow, discount to present value. Okay, so that's how you determine your fair value. Okay, right, next. Derecognition of investment property. Derecognition means take out. Derecognition means remove from account, right? Under what kind of situation you should remove from account? Okay, so two situations: when there is a sale, obviously, if I sell, I need to remove, correct? When there's a sale, I need to remove. And the other situation is when there's no more future economic benefit. Okay, so these are the two situations I will need to derecognize it, need to say remove. Okay, so FR type of question, two category. One is property for own use and to earn rental income. Okay, so the keyword is and. I use it for myself and I use it to earn rental income. Can you see? Property for own use and to earn rental income. So for example, I have one building. Second level, maybe I use it for myself. Very common. Own use. Then the first level, I rent out to other people. Okay, so very simple. The portion that you use to earn income, then of course you will group under investment property. So I just put IP. Okay, investment property. Then the portion for own use, I will park under PPE. Okay, right. Then next, if let's say the property is rented to group member, right? So group member means what? Group member means to say either talking about your subsidiary or your parent. That's the meaning of group member, right? Okay. Example, parent or subsidiary. Okay. So if property is rented to group member, then be very careful on whose account you are doing. If you are doing the lessor books, lessor also means to say it's the landlord. Also known as company level, you should record as investment property. Okay, so if you are doing the consolidated financial statement, you should record it as a PPE. Okay, you should record as a PPE because under console point of view, when a parent rents something to a subsidiary, in consolidation point of view, it's the same as I rent to myself. Can see? So you assume this transaction has not happened. So therefore, you still put it back as a PPE. Right? Okay. So in consolidation point of view, which we'll discuss the second time we met, no? Consolidated financial statement means to say when parent rent to subsidiary, in consolidation point of view, it means I rent to myself. Okay, so I'll repeat one more time. In consolidated financial statement, console point of view, when parent rent to subsidiary, it means I rent to myself. Okay, so this is disregarded and still treated as a PPE. So it depends on whose account you're doing. If you are doing consolidated account, still put it as PPE. If you are not doing consolidated account, means to say you are doing the normal company account, then you should classify it as an investment property. Okay, right. So next we talk about transfer. Right. So inside your mind, please go and think. Transfer means what? Transfer means to say maybe, for example, I transfer from investment property to PPE. Right. I don't want to rent to other people anymore. So now I decide to use it for myself. Can see? Right. Then the other direction must be from PPE to investment property. Okay, so that's transfer. Can so two direction. One is from investment property to PPE, and the other one is from PPE to investment property. Right. So when you do transfer, right, depends on the model, right? So I do the easy one first. So initially, let's say, for example, I'm going to transfer my investment property to PPE. My investment property is under cost model, right? Okay, so remember we have two model, right? One is cost model, and of course the other one is fair value model. So let me do the cost model one first, it's easier. All right. So if I want to transfer investment property cost model to PPE, what should I do? Okay. The figure must be based on carrying value of investment property at date of transfer. So firstly, you need to determine the date of transfer. So in this case, for example, my date of transfer is 31st December, right? So double entry, I think everybody will know. Transfer from investment property to PPE. So my double entry should be debit PPE, correct? And credit investment property. This is the double entry. So the thing is don't know how much, right? So they say your PPE value, right, should be the carrying value of investment property at the day of transfer, right? So day of transfer is 31st December. So my investment property at day of transfer is 1,000. So obviously this is the easiest. I will need to debit my PPE 1,000 and then credit my investment property also 1,000. This is the easiest situation, right? Okay, then let me fast forward. I do the other one first, cost model. Now from PPE, cost model to investment property, right? Okay, from PPE to investment property. So of course, I come up with the double entry first. I will need to debit investment property and then credit my PPE, correct? I'll be able to think of this double entry. So which value should I use? They say use the carrying value of the PPE at the day of transfer, right? Okay, so same thing, day of transfer is 31st December. If my PPE carrying value is 1,000, then that will be the amount I'm going to transfer. Okay, right. So that's the first part. Then now a little bit of complication if initially the model is fair value model. So just now what we did is initially all the model are cost model. This is easy. Initially all cost model. Just now also cost model. So now slightly more complicated if initially now is at fair value model. Okay, so I tell you normally how I do it. Okay, I tell you normally how I do it. Very simple. Okay, so firstly, I go and think about the double entry first. What I'm going to do is I'm going to transfer investment property to PPE, right? So therefore, my double entry must be debit PPE, right? Okay, I know I have to debit PPE, right? Then I need to credit my investment property. This is the first thing I know, right? Debit PPE and credit investment property. Okay, so I come up with this first. Then next, then I look at this part. Okay, the amount that you should include as your PPE, right, should be the fair value of investment property at the date of transfer, right? The amount that you should include as PPE should be the value of the fair value of investment property at date of transfer, right? So my date of transfer is 31st December 2020. So look out for this number, fair value of investment property at date of transfer, which is this 1,000, right? That's this amount. Okay, right? So of course, the PPE amount will be this figure, 1,000, right? So I determine this number first. So my destination is PPE. Then I follow the rule. It should be the fair value of investment property at date of transfer, which is 1,000. Okay. Then next, what I need to do is to remove my value, right? Is to remove my value in my investment property. Okay. My investment property, of course, the value now is 600. I will need to remove it. Remove a 600 here. Okay. So that's how I get 600. So ultimately, what I left is a 400. Okay, ultimately, what I left is a 400 here. So this 400, I have one little problem. Is this 400 will go where? There's only two destinations. One is P&L, and one is your OCI. Okay, P&L or OCI. So very simple. I look at the value here. Initially, it's talking about investment property fair value. So if you remember, under investment property, fair value model will go to P&L. So therefore, this 400 will be a balancing figure and it will go to P&L here. Okay, so this one depends on your original source. Originally is in investment property fair value model. So fair value model inside my mind, I already know must be P&L. So you go to P&L. So this 400, normally I will put it as a balancing figure. Okay, right. So I still got another one. Okay, another one. This part from PPE to investment property. Right, from PPE to investment property. So of course, same thing. I will come up with the double entry first. I will debit investment property, and of course, I will credit my PPE. Okay, right. Then same thing. I ask myself this question. Now, as I say, the other entry, right? It can either be OCI or P&L. So it depends where is the original source. Okay, the original source you see is revaluation model. So revaluation model, of course, I will know this will be my RR. Okay, so that's the thing I always think about. So this part will be RR. Okay. Okay, once I have the double entry, then everything will be easy. Right, okay. And this part, we value the property to fair value at date of transfer. Right, so the date of transfer is 31st December. So my fair value to be included here must be 1,000. Right? Oops, sorry. Yeah. Okay, then my PPE, very simple. Initially, is recorded at 600. So, of course, I need to remove it. 600. Okay, then my RR, I will leave it as a balancing figure, 400. Okay, so this 400, again, will be a balancing figure. Okay, right. So that is IAS 40 investment property. So I don't think I have any question on this investment property. This one, nothing much. Okay, so I got no question. What you need to know for exam is this. Just bear in mind, there's such thing called a transfer, right? So in other words, mean to say in your T account, right? What you need to know is this. Okay, for example, I have one PPE account. Okay, then let's say, for example, I have one investment property account. Okay, so be mindful inside their T account, there's one element, transfer from investment property. So for PPE, right? So maybe I will have one entry called transfer from investment property. So here I might have one element called investment property coming from investment property. Remember the double entry? If I talk about the easy one, I don't care about the fair value thing. I debit PPE, correct? And I credit investment property. Okay, so if I follow this double entry, what you see above will be valid. On the debit side of PPE, you will have an investment property here. Okay, the reason why I draw this is because to prepare you for statement of cash flow. Right, statement of cash flow, don't be surprised. You need to fill in this element, PPE, investment property. Right, so likewise for investment property, the double entry maybe can be you transfer from your PPE, right? So you will debit investment property, okay, and you will credit your PPE. So therefore, on the debit side of this investment property, you might have something called a PPE here. Okay, right. So that is investment property. No questions on this chapter. Okay, then now I think we go for a short break. Then we continue with the next chapter called government grant. Okay, so now we go for a short break. So come back in 15 minutes time. Okay, welcome back. Okay, right. So now we are going to proceed with the next IAS, which is IAS 20, accounting for government grant. Okay, which is here on this page 24. Okay, page 24. So please turn to this page. Okay, so the name is accounting for government grant. Okay, so I'm very sure recently we are all hit by the COVID-19. Okay, so I'm very sure your government will have given to you some kind of grant. Okay, so hopefully later you are able to see you can link to what we are going to discuss. Okay, the government grant that Vietnam government give to you, you see whether you can link to what we are going to discuss. Okay, so firstly, definition of government grant. Okay, definition of government grant is by which government actually provide resources. Okay, so of course, what you want from the government, I think we only want one thing from the government, correct? Which is money, right? We are interested in money from the government. Okay, but just for information, in your exam context, right? Government not just give you money, they can also give you an asset. For example, PPE. Okay, so government provide resources in the form of money or maybe a PPE. So of course, nothing is for free. In return, you will need to comply with certain condition, right? You need to comply with certain condition. So maybe for example, okay, you need to employ a certain number of employee. Okay, so not for free. Of course, one of the condition might be you need to employ a certain number of employee. Okay, so that's the definition of government grant. Then next we move on to recognition, right? So for recognition, company must comply with the condition. Okay, so of course, you need to employ a certain number of employee. And the other one is company, rather the government must honor their promise. Okay, so some country, of course, their government does not honor their promise. Okay, they only say certain things during election, but after they are elected, then nothing happened. Okay, so anyway, one of the criteria is the company, rather the government have to honor their promise. Okay, now accounting treatment for government grant. So what you see on this page is a big picture on the accounting for government grant. Okay, so the first step is you need to determine your government grant, right? Is it monetary or non-monetary, right? That's the first step. First step is you need to determine whether your government grant is non-monetary or monetary. That's the first step. Okay, of course, non-monetary, I already told you, it means, example, PPE. Then monetary, of course, it means money. Right, that's the first step. When you receive a government grant, determine whether it's monetary or non-monetary. Non-monetary, government give you an asset. Monetary, government give you money, right? So for monetary grant, there's one more step. Okay, so monetary grant, there's one more step. You have to see government give you money for what? Is it for revenue, expenditure, or is it for capital expenditure? Why they give you money? Is it for capital expenditure or revenue expenditure? Okay, so revenue expenditure, of course, example would be what? Example of revenue expenditure is government give you money, right? To help you pay for your salary, payment of wages. That's example of revenue expenditure. Okay, help you to pay your salary. Wages is a P&L item, so revenue expenditure. Okay, so I think you can guess how come government give you money for capital expenditure. Example of capital expenditure will be what? Government give you money to buy PPE. Okay, government give you money to buy PPE. So that's example of capital expenditure. So you need to determine what is the purpose, right? Whether they help you to solve your revenue expenditure or capital expenditure. Okay, so usually government, how come they want to solve your revenue expenditure? In Singapore, government will give government grant to support payment of salary if your company industry is in shortage in Singapore. For example, Singapore short of biology industry, right? If they want to encourage people to start biology industry, then they have to do something about it, right? For example, give grant. Okay, so I think for most countries the same. If your country maybe, for example, short of biology, then if you set up a biology industry, government will give you money, right? Give you money for what? To help you defray your day-to-day expenditure. Okay, so something like that. That's why government give you money. Okay, so example, maybe I'll just put here so that it will be complete for you. How government give you money to pay salary? Usually for what? Maybe an industry which is in shortage in the country. Okay, an industry which is in shortage in the country. Okay, for example, inventing medicine, right? Okay, inventing medicine. Recently, when nobody have the vaccine, then a lot of country they give incentive for company to invent medicine, right? The vaccine. Okay, right. So with that, then now we can talk about the accounting treatment for the first one, non-monetary grant. Non-monetary grant, government give you an PPE, give you a PPE. So what do you do? Right, so the first one is non-monetary grant. You receive an asset. Asset means PPE. Right, so treatment is this: set up the grant as a deferred income, deduct the grant in arriving at the carrying amount of the asset. Okay, so of course I show you the information. Company receive an asset worth 5 million with a useful life of 5 years from the government. Okay, then what do you do? Okay, so of course government give you PPE, right? So therefore, very logical, you will debit PPE. Okay, but where will you credit? You can't credit bank because you didn't pay, right? So the credit will go to one liability account, and this liability account is called deferred income. Okay, don't worry about this deferred income. It's the same as our prepaid income. Same nature. Remember prepaid income? We have accrued income, prepaid income. Prepaid income is a liability. So this deferred income, something similar to prepaid income. Okay, so that's the accounting entry. So when government give you a PPE, then this is what you should do. Debit PPE 5 million and credit deferred income 5 million. Okay, so that's what you should do when you receive an asset from the government. Okay, then of course, since it goes to PPE, then of course you will need to calculate depreciation, right? Depreciation, of course, is the same as what we normally do. Depreciation, you will debit depreciation. Okay, then of course you will credit accumulated depreciation. Right? Nothing special. So depreciation 5 million, 5 years. So of course that will be 1 million. Right? That will be 1 million. Okay, how to get 1 million? Just use 5 million divided by 5 years, just like that. Okay, right. Then we have one more entry, which is relating to this liability account. So of course, we need to do something to this liability account, right? You can't park inside this liability account for the rest of the accounting years, right? So what you need to do is you need to remove this liability account, slowly release it to your income statement. Okay, slowly release it to your income statement. In textbook, they call it deduct the grant in arriving at the carrying amount of the asset. Okay, but to me, simply means you release this liability to your P&L. Release it. So release it means to say you will debit this liability account, right? You will debit this liability account. Defer income, right? Okay, and you will credit P&L. Okay, and of course, the amount is equal to 5 million over 5 years. So same thing, 1 million and 1 million. Okay, right. So in Singapore, they don't call it deduct the grant in arriving at the carrying amount of the asset. Okay, so I give you another word, another sentence. This sentence, right, it means amortization of government grant. Okay, this sentence actually means amortization of government grant. Okay, I think this is a sentence which is used by the industry, right? I think accountant, they use this sentence, amortization of government grant, instead of what deduct the grant in arriving at the carrying amount of the asset. Okay, so next time, amortization of government grant, it means this. So what you're trying to do is what? You're slowly releasing the government grant into P&L as an income. That's what you're trying to do. All these are government grant, right? All these are income to you eventually. So initially, you park as a liability, right? Initially, you park as a liability. So it's logical that you will not remain as liability forever. So over the years, you need to slowly release it to your P&L as an income. Okay, so I hope you know, if you credit P&L, imply this is an income. Okay, if you credit P&L, confirm this is an income. So what you're trying to do is you are slowly releasing the liability to your P&L as an income. Okay, right. So of course, I just show you something lah. Okay, so eventually what will happen? Okay, eventually I just show you here. So eventually in your SOCI, just show you the full picture. In your SOCI, there will be one section called income. Okay, there will be one section called income, definitely. And this income is called amortization of government grant. Singapore context, we call it this, amortization of government grant. $1 million. Okay, so this 1 million actually come from this credit P&L. This credit P&L, right, eventually will come here. Okay, so that's how it looks in your account. Okay, right. So this is using a straight line method. So what happened? if they use a reducing balancing method. Okay, so of course, the double entry will be the same. Set up the grant as a deferred income, it will be the same. Means to say you will debit your PPE and you will credit a liability called deferred income, right? The double entry is the same. Of course, the amount will also be the same. So in this case, 100 million. So here, I will have a 100 million. Okay, that's the first part. Receive asset, debit PPE, and credit a liability account called deferred income, 100 million. Your depreciation, of course, the double entry will be the same. Regardless which method you are using, double entry is the same. Debit, depreciation, and credit accumulated depreciation. Okay, but now, of course, the value will be different. Okay, on the right-hand side, you see the depreciation. Year 1 is 10. Year 2 is 9. Right? Okay, so of course, depreciation, year 1 is 10. Right? And year 2 is 9. Okay? Right. Then this one, deduct the grant in arriving at the carrying amount of the asset. So remember, this one means amortization of government grant. Okay, so amortization of government grant, the double entry will be the same, by which you will debit the liability, defer income, and credit P and L. Right? Okay, then of course the amount will not be the same every year. The first year, it will be 10. And of course, the second year, it will be 9. Okay, right. So that's what you should do if you receive an asset from the government. Right? Okay, not very common. Usually government don't give asset, right? Okay, but anyway, if you receive an asset from the government, this is what you should do. Debit PPE and credit a liability account called deferred income. Okay, so once you debited PPE, then of course you need to account for depreciation as usual. Then for this part, the liability part, you need to do something called amortization of government grant. Okay, so in short, this amortization of government grant, it means release the liability to your income statement as an income. Okay, right. So that's the first part. We completed the first part, which is here. Non-monetary grant, this one done. Right. So now we look at this one, monetary grant. So if government give you monetary grant, you have to decide whether it's relating to revenue or capital. Okay, so say for example, it's relating to revenue, like what you see over here. Monetary grant for revenue expenditure. Right? Okay, so what I need to do is you need to present as other income or deduct from expenses. So either you put it as other income or you deduct from other expenses. So company receive 5,000 cash from government for assistance on rising wages. Okay, so I think now we also have the COVID-19, right? Not very sure your Vietnam government, did they give you any incentive to cope with the salary? Okay, if yes, right, I think it will fall under here. Monetary grant for revenue expenditure. Okay, so if you receive money from the government, of course, what you will do, you will debit bank. Okay, either you can credit other income or you can credit the expense. In this case, it will be wages. Okay, up to you. You can either credit other income or deduct from related expenses. In this case, wages. Okay, then of course the amount will be this 5,000. Okay, so very easy. But what happens if the grant is for 5 years? Right, what happens if the grant is for 5 years? So of course, very logical, you will not be able to recognize the whole 5,000 in your P&L, right? You can't do that. So for example, company received 25,000 in cash in total on rising wages for 5 years. Okay, so you can't recognize the whole thing in your P&L. So what you need to do is this: you will debit bank. Okay, I think you can guess. You will go to your liability account. Liability, defer income, right? Okay. So here I will have a 25,000. So can't go straight to your P&L, right? Okay. Then this deferred income, I think you can guess, slowly you will need to release it to your income statement as an income. Okay, so that's called amortization of government grant. If you remember, the double entry is debit liability, defer income, and credit P and L. Okay, so over the grant period, so 25,000 divided by 5, that will be 5,000. Okay, so how you get this is equal to 25,000 divided by 5. Okay, next. So we are done for revenue expenditure, monetary grant. So what happens if government give you monetary grant for capital expenditure, right? So now it's monetary grant for capital expenditure. Okay, so the question is something like this. On 1st of January 2010, ABC acquired a machine at a cost of 60 million. Economic useful life is estimated to be 10 years with 0 residual value. ABC uses straight line depreciation. So now government received a 10 million monetary grant on 1st of January. Okay, so this grant is relating to machine. Right, so machine, of course, it means a capital expenditure. Okay, so if government give you money to buy a machine, it means monetary grant for capital expenditure. Okay, so you have 2 ways to deal with this 10 million. The first way, as you can read, reduce the cost of the asset. Okay, the second way is to set up the grant as a deferred income. Right, then after that, deduct the grant in arriving at the carrying amount of the asset. Okay, so this sentence means what? Amortization of government grant, remember? Okay, this sentence, deduct the grant in arriving at the carrying amount of the asset. This one is the one we are talking about. Amortization of government grant. Okay, so be familiar with this sentence. Deduct the grant at arriving at the amount of the asset. Simply means amortization of government grant. Okay. So maybe they will ask you the accounting standard. They will ask you, what happened if you receive a monetary grant from the government relating to capital expenditure? Okay, then look out for this word. Set up the grant as a deferred income and deduct the grant in arriving at the carrying amount of the asset. Okay, so that's what they are trying to say. So now let's look at the entry here. So remember, I got 2 options. One is to reduce the cost of the asset, and the other one is to set up as a deferred income and do amortization of government grant. So let's do the first one first. Reduce the cost of the asset. Okay, so of course I received 10 million from the government. So reduce the cost of the asset. I think you are able to guess, right? The accounting entry must be debit bank. Okay, then reduce the cost of the asset must be credit machine. Okay, And of course, the amount must be 10. Okay, then depreciation, of course, you will still do depreciation. Double entry will still be the same. You will still debit depreciation and credit accumulated dip. Okay, but the amount, be very careful. Initially, your machine was 60, correct? But you credited 10. So therefore, you left 50. So you will calculate depreciation based on 50 and over 10 years. Okay, so you know I get 50, yeah? 60 minus 10. So therefore, my depreciation will be 5. Right? Okay. Right. So anyway, I just show you 60 minus 10. That's how I get 50.